Welcome to the Deep Dive. Today is August 22nd, and the financial world is, well, buzzing about Opendoor. Their stock, ticker Open, surged, what, 40%?
A whopping 40%, yeah. It's quite dramatic.
So the big question is why? What's behind this huge jump? And how does it tie into the bigger picture, like Jerome Powell hinting at maybe cutting rates in September?
Exactly. We've looked at the financial news, economic analysis, market research, even what investors are saying online. The goal today is really to unpack all these threads, the big macro stuff, the company specifics, market mood, and give you a clearer picture than just the headlines.
Okay, let's dive in. The immediate spark seems to be Federal Reserve Chair Jerome Powell's speech today, August 22nd. That felt like the catalyst, right?
Absolutely the catalyst. Speaking from Jackson Hole, he mentioned risks to inflation being tilted to the upside, but risks to employment leaning to the downside. And that led him to strongly suggest, that adjusting policy might be needed. He hinted pretty clearly at an interest rate cut coming up at the September 17th meeting.
Which would be the first cut since December 2024.
That's right, the first reduction in quite a while.
And Wall Street loved it. The S&P 500 jumped, what, 1.3%? So for you listening, why is a potential rate cut such a big deal for the whole market?
Well, the Fed's job is twofold, right? Stable prices, they aim for 2% inflation using the PCE measure and keeping employment high. Lowering interest rates generally makes borrowing cheaper.
Right.
That tends to boost spending on big-ticket items like business investments, consumer goods, and, crucially for this story, housing. It can also affect the dollar's value, impacting trade.
And Powell mentioned tariffs, too.
He did. He acknowledged them as an ongoing inflation risk, calling them a kind of one-time shift in the price level that takes time to sort of ripple through supply chains.
But it's interesting because just a few months back, not everyone was so sure about quick cuts.
That's a great point. If you look back, say, Deloitte's analysis from December 2024, they were only expecting maybe 50 basis points of cuts in 2025.
Half of what they thought earlier.
Exactly. Half of their September 2024 projection. And that was because core PCE inflation was still sticky, around 2.8%, and the job market looked really strong.
So that contrast really highlights how fast things can change, how much weight even a hint from the Fed carries now.
It really does. Shows how expectations pivot.
Okay, so bringing back from the macro level, what does this Fed signal mean for a specific company like Opendoor, seeing that huge 40% jump today?
Right. Opendoor. Open. It's historically been a very volatile stock, often gets caught up in that whole meme stock dynamic. This latest surge definitely seems fueled by some renewed, let's call it speculative enthusiasm. You've got high-profile investors jumping in, like Anthony Pompliano took a big position publicly.
And wasn't there someone calling it a 100-bagger?
Yeah, Eric Jackson from EMJ Capital, he compared it to Carvana's massive rebound after they hit rough times. So big claims are being made.
It is fascinating how quickly things can swing for a company like this. I mean, it really makes you wonder sometimes.
It really does. Open stock shot up, 245% back in July? Hit $3.21.
Wow.
Then, bam, tumbled over 40% after their Q2 earnings report gave pretty weak guidance. They've also been facing a potential delisting from NASDAQ.
Oh, right, the reverse stock split proposal.
Exactly, to try and boost the share price back up. So today's rally certainly gives them, some breathing room on meeting those listing standards.
So beyond all the hype and the stock chart drama, how's the actual business looking?
Well, Q2 revenues were up 4% year over year, about $1.57 billion. But their guidance for Q3 is pretty gloomy.
Gloomy. How so?
They're forecasting $800 to $875 million. That's way down from $1.4 billion the year before. They're blaming the challenging housing market, mainly high mortgage rates.
Makes sense.
They are making a strategic shift, moving towards an agent-led model. Pilot projects apparently showed much better results, like 5 times higher listing conversion rates.
Okay, that sounds promising. Long-term, maybe?
Potentially, yes. But it's early days, and it comes with higher restructuring costs right now. It's worth noting Zacks currently rates Open as a hashtag for sell, even with what they call a discounted valuation.
A sell rating, despite the discount. So this brings up a really key question. How do these big Fed signals, the macro stuff, actually connect with something so specific and maybe sentiment-driven, like Opendoor's stock?
It's a crucial link. Lower interest rates are definitely a tailwind for housing, which is Opendoor's bread and butter. Theoretically, it helps sell homes faster, eases debt pressure.
Theoretically.
Right. But for a stock often labeled a meme stock, that macro news, like Powell's hint, often acts more like a powerful catalyst. It ignites the existing market sentiment, technical factors kick in more liquidity, investors piling in often for reasons beyond just the pure fundamentals.
And that combination just amplifies the price swings.
Precisely. It can lead to these huge moves.
So market mood, the psychology, can just sort of overwhelm the underlying business reality, at least in the short term.
It absolutely can. Market sentiment, the collective feeling of investors, it can be subjective, biased, and yeah, it can definitely push fundamentals aside sometimes. We see this with what's sometimes called dirty volatility.
Dirty volatility.
Yeah, volatility driven by these specific, often unexpected events, like a big policy announcement. It causes these sharp spikes or drops, very different from the sort of everyday ups and downs, the clean volatility of normal trading.
Okay, we've definitely covered a lot of ground today, digging into this open door surge and connecting it back to Jerome Powell. It's such a clear example of how everything's tangled together: Fed policy, company specifics, and that very powerful investor psychology.
Absolutely. Understanding that mix is really vital if you're trying to navigate these markets.
So the final thought to leave you with: when a hint from the Fed can spark a 40% rally, how do you tell the difference between just short-term noise, a reaction, and a real sustainable shift in value? What other signs would you look for to see beyond the immediate volatility?